You open your bank app and there it is, a shiny banner saying you are pre-qualified for a new card, a refinance, or a personal loan. It feels like a soft yes. Then you click through, the hard pull happens, and the offer either disappears or comes back more expensive. In this video, you will learn what pre-qualified usually means behind the scenes, and you will be able to tell, before you apply, whether an offer is a real near approval or just a data test that can change the moment the lender looks closer. Picture this. You want to buy a used car in about 6 weeks. You are not desperate today, but you care about the rate because 1% on an auto loan is not a rounding error. Then a pre-qualified offer shows up that looks like it was made for you. Here is the core idea. Most pre-qualified offers are not approvals. They are a marketing filter built on partial information. What the lender is doing is a two-step process. First is a snapshot. They run a model using whatever they can see without a hard inquiry, plus any relationship data if you already bank with them. Second is the gate. When you apply, they switch from marketing mode to underwriting mode, verify income and identity, count debts their way, and price the loan based on today's rules. If you only remember one line, remember this. Pre-qualified means you fit our snapshot. Approved means you passed our full check. Now, let's make this practical using the car in 6 weeks plan. Say your score is around 720. You have one card with a $2,000 balance and a $10,000 limit. You see the offer and think, great, I will apply and lock it in. But 3 things can change between the snapshot and the hard pull. First mechanism, utilization moves faster than your habits. If your balance reports higher on your statement, your utilization can jump even if you plan to pay it off next payday. At $2,000 on a $10,000 limit, you are at 20%. If your statement closes at $4,500, you are at 45%. Same person, different snapshot. Some lenders treat that jump as higher risk right now, and it can move your rate or your approval amount. What to check is simple. Look up your statement closing date. That is the balance the bureaus usually see. Your due date is not the same thing. Second mechanism, debt to income is not your budget. It is their formula. Underwriting compares your verified income to your required monthly obligations. And lenders often count minimum required payments, not what you choose to pay. So if you have multiple cards, a student loan, or a new payment you just took on, the ratio can land on the wrong side of their line even if you feel fine month to month. What to check here is one screen and one document. Scan your credit report summary for monthly payment amounts, then compare it to your most recent pay stub, because that is what underwriting treats as real. Here is a quick number example so you can feel it. Say your verified gross income is $6,000 a month. Your required minimums across cards and loans total $900. That is 15% of gross before the new car payment. If the estimated car payment is $450, you are at $1,350, or about 22%. Some lenders are fine with that. Others get stricter once you add housing costs, and some will treat variable income, like overtime or the gig work, as less reliable. So the same household can look safe to one lender and borderline to another. And there is a fourth detail that trips people up, even though it is not a separate mechanism. The act of applying changes the picture. A hard inquiry can shave a few points off your score in the short run, and a new account can change your average account age. That does not mean you should fear every inquiry. It just means your best shot is usually when your profile is stable and clean, not when you are mid-swing. That is why the timing around big purchases matters. If you're going to shop for a car loan, try to do your comparisons close together, then stop. If you scatter applications across months, it can look like repeated attempts to borrow, and some lenders treat that as a risk signal. Third mechanism, the offer can move because the lender's box moves. Promos have quotas, rate sheets update, and a campaign that was loose 2 weeks ago can tighten quietly. This is why you see rates as low as language. The lowest rate is for a narrow slice. When you apply, you get placed into the slice you actually fit today. Here's the common misread. People think the offer is about them. A lot of the time, it is about the lender's pipeline and today's risk rules. Now, the counterpoint. Sometimes pre-qualified really is strong. Some lenders run a deeper pre-approval that includes income verification. But the key is not the word, it is what steps were actually done. So treat pre-qualified like a probability, not a promise, and make your decision based on timeline. If you do not need credit in the next 30 to 60 days, one option some people consider is ignoring the marketing and letting their snapshot look cleaner before they apply. The upside is fewer hard pulls. The downside is you might miss a short promo window. If you do need credit soon, like our 6-week car plan, the goal is to control what the lender will see on the day you apply. A common approach is to get utilization lower before the statement closes, not after. Another is to have income docs ready, so verification does not stall or contradict what you enter. And if you are comparing lenders, do your rate shopping in a tight window, so inquiries look like shopping, not scatter. That is information, not a recommendation. It is just how the system tends to score what it sees. Now, exactly 3 signals you can watch so you are not guessing. Signal 1 is reported utilization. Where to look is your statement balance. Then your credit report a week or 2 after the statement closes. If reported utilization is rising, lenders can price you as higher risk right now. The timing is fast, usually 1 statement cycle. Signal 2 is inquiry and new account activity. Where to look is the inquiries section of your credit report and your credit monitoring app if you use one. If you have multiple recent inquiries or a brand new account reporting, some lenders will treat you as actively seeking credit and tighten the terms they are willing to offer. The timing is usually within days to a few weeks because inquiries post quickly. Signal 3 is lender tightening, which shows up before headlines. Where to look is not a news article first. It is your own offers. If you suddenly see smaller limits, fewer 0% promos, higher as low as rates, or more denials in your circle, that is often the early signal that the lending box moved. Then you can confirm it by checking the Federal Reserve's Senior Loan Officer Opinion Survey for whether banks are tightening standards. The timing is slower, often weeks to a quarter, but the offers can change overnight. Back to the car in 6 weeks scenario. If you want the cleanest read of your odds, you do a simple pre-flight check. First, open your credit card and find the statement closing date. If your plan is to apply soon, the balance that matters is the one that will report, not the one you will pay later. Second, look at the minimum payment totals across your accounts. Underwriting is looking at required payments. If you do not know them, your budget math can be totally different from their math. Third, read the offer page carefully for the line that tells you what it really is. If it says subject to verification, final terms depend on credit review, or anything similar, that is your cue that you are still in. Step 1, the snapshot. Now your 2-minute checklist, so this does not stay theoretical. Find your statement closing dates for any cards you carry. Balance is on. Write down your current balance and your credit limit, and compute utilization as balance divided by limit. Pull your credit report and check current limits, reported balances, and recent inquiries. Confirm your monthly minimum payments across debt, because that is what underwriting counts. If you are planning a loan soon, keep your rate shopping in a tight window, then stop applying. Treat pre-qualified as a probability, and make sure you can live with the outcome if the final offer is worse. The point is not to fear pre-qualified offers. It is to stop letting one word trick you into thinking the lender already did the hard part. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns, and leave a comment with the next topic you want covered or the one part of today's video you want explained even simpler.